Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, November 11th, 2023. I hope you're doing well. Thank you so much for coming and visiting me for my weekend review podcast. In this podcast, the format is going to be as follows. First of all, we are going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the trades I made last week, both on the daily charts and the weekly charts. We're going to talk about when I bought them, why I bought them, what strategy, what setup I used to buy them, and then most importantly, how I am going to manage the trade going forward, either to the upside or to the downside. After that, we are going to talk a little bit about trader psychology. Always the most important skill in trading, in my opinion, is the ability to create a plan using good trading principles and then being able to follow through on that plan. You can have the best trading plan, the best trading strategy in the world, but if you don't have the ability to follow what it's telling you to do, why even have it, right? So it's very important to follow your process, very, very important to follow your plan, and that all comes down to what's between our ears, and that's our brain and our emotions and all of that. So we'll talk a little bit about that. Always helpful for me to teach it. I hope it's helpful for you when you listen to it. After that, I have gone down through my master watch list, both on the daily time frames and on the weekly time frames, and I have identified some potential setups for next week that I am interested in. You know, when I'm looking for a setup, I usually need something to go lower, reject a key level below me, reject it, and then show me that that level's been rejected so that it gives me a good risk to reward ratio. Then I need to position size correctly based upon the volatility of the market. I personally place an emergency stop, which is the worst case scenario. I also have an end of day stop, which ideally is very close to the level that I entered. And then I take profits if it moves up 0.45 ATRs from the previous day's close. I take partial profits, not all, but just partial. And then I have certain levels above me that if I get to, then I tighten my stop up even more, get into a trailing stop mode. And then there's several levels above that. 65 RSI comes into play, 70 RSI, some other rules come into play. But that is usually how I trade. I've been trading for 28 years, has really worked out well for me. All sorts of different ways to trade, but you know, I've studied with five very well-known traders, authors, learned all of their trading strategies, and then combined them into my own strategy, which is what I go through here each week and show you. So I do use five main strategies, and you'll see some of the trades I've had this week. You know, both. You know, I'll highlight some of the different trading strategies that I use. Not all of them are going to be winners. We're going to have lots of losers, but the key is that you set yourself up so if you have a loss, it's a small loss, and if you have and then every once in a while you're going to have potential for a large win, and those large wins are going to pay for all your little losses plus more, and that's really the calculus of trading. So looking for trades both on the daily and the weeklies. You know, we had such a big run up last week that there are not a lot of good potential setups at the moment. I have found some both on the daily and the weeklies, and we're going to be talking about some short possibilities, especially on the weeklies as well. You know, what's going on with the economy, interest rates, all this kind of stuff. There's really no reason that we should be rallying like we are, but this is a really key takeaway in trading is that don't trade your opinions. If I was only trading my opinions, I would be short all the time. But the market has other ideas, and you have to trade what the market's doing, not what you want it to do. So it's an important lesson in just following your rules, even if it goes against what you think the market should be doing, and just trading the price action instead of trading your opinions. This is a very good example of this. So go down, I'll show you what I've highlighted both on the daily and on the weeklies. And if the price gets there, I will potentially take the trade, and we'll just have to see how it all looks. But we'll go over the dailies and the weeklies. So that's the format for today in today's podcast. So I need to run the U.S. legal disclaimer. Hang tight for about 40 seconds, and I'll be right back. Thank you.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, thanks for holding through that with me. Okay, so let's get started. First position of last week on the dailies was the SPY, S&P 500. Why did I buy this down here? Had a really good trade on this, bought this on the 30th of October at 414.80. Well, a lot of the trades I use are called the deep dip buy stock trading strategy. And in this particular case, the day before on the 27th, we closed below the 30 RSI. The next day, we closed above the 30 RSI. That by itself is a legitimate signal, entry long signal. Close under 30 RSI, close over 30 RSI. In addition to that, I had a V2 entry signal. I really like V1s, V2s. If you'd like to learn more about them, just go to my YouTube channel in my lessons playlist. Just look up V1s, V2s. So that's a really popular video, and it's really a big part of my trading is the confluence combination of indicators lining up. The main signal that I had here was the close under, close over, but I like to have more than one signal. So I had the close under 30, close over 30. Actually, I also had the close under the 300-day moving average. This is the orange line here, close over. So multiple signals, close under, close over 30, close under the 300, close over the 300, and a V2, bar 1, bar 2, bar 3. Bar 2 goes below bar 1's low. Bar 3 closes above bar 1's close. Look at the nice confluence, nice trifecta of signals. Under 30, over 30, under 300, over 30, over 300, and a V2 entry signal. So I got long here for 1480. Now I mentioned position sizing based upon volatility. Let me go through that with you real quick. So when you have a setup, you have to factor in the volatility of the market. How do you do that? Well, first step is, and it's based upon my account value. Let's just say it's a hypothetical $100,000 account value. 1% of that is a good rule of thumb for me. If it was a $50,000 account, maximum allowed loss would be 500. If it's a $100,000 trading account, maximum allowed loss is 1%, which is 1,000. If it's $1 million trading account, 1% is 10,000. So depending on the value of your account, so hypothetical $100,000 account times 1% is $1,000. I divide that by the current value of the 2 ATR, which right now is 1101. So divided by 1101, that would show me the correct amount of shares to buy would be 90.82, or we can round up here to $91, 91 shares. If the volatility was lower, then it would tell me to buy more shares. If the volatility was higher, it would tell me to buy fewer shares. All right. So as soon as I see my setup, then I adjust for the position size based upon the volatility. So this tells me to buy 91 shares. Now, two stops: emergency stop, end of day stop. The emergency stop is always going to be exactly the value of the 2 ATR that I used in the equation, 1,000 divided by 1101, giving me 91 shares. I will place my emergency stop exactly 11.01 points below my entry point. So if I have 91 shares and it goes down to my emergency stop, which is 1101 below, how much have I lost? $1,000. That's the maximum I can lose on the trade, unless it gaps down below that. That's always a possibility, but very unlikely because it's 2 ATRs below my entry. So I base all of my trades upon the closing price of the day. I always feel like that's the most important. The closing price is the most important price of the day, because at the end of the day, the large financial institutions come in, they're dealing with the most money, they have very smart people, they have the best technology, and that closing price is important. So I make my buying and selling decisions based upon that closing price, unless it hits my emergency stop. And if it hits my emergency stop, I'm out, whether it's 1 minute after the market opens or 1 minute before the market closes. So during the day, if it had gone down and hit this, I would get out. How much will I have lost? Well, I already did the math, right? 1% of my capital, 1,000, divided by 1101. In the worst case scenario here, that's going to be my maximum allowed loss. But this only happens 5% of the time. The other 95% of the time, your end of day stop is going to come into play, which will be much lower. Well, why did I take the trade? Under 30, over 30, under 300, over 300. If I have that choice, when I have an under 30, over 30, and an under a major moving average and over major moving average, I default to my end of day stop being a close under the 300. So if the next day it had simply closed even 1 penny under, I simply would have got out for a very small loss. Remember, even if I get to my emergency stop, I've only lost 1%. So if it closed barely under, it would be much less than 1%, right? So emergency stop, end of day stop would be a close below the 300-day moving average. Now, I have an orange line up here. This is my trailing stop level. This is exactly 1.5 ATRs above my entry. If I ever get there, then I go into trailing stop mode, which means in the future, if I have a close below a previous bar's low, I will get out of half of the position. So bought here, next day went up, next day went up, didn't quite get to trailing stop level. The next day here on the second, it did get to my trailing stop level. Doesn't mean I do anything. It just means in the future now, if I have a close below a previous bar's low, I will get out of half. And in addition to that, every day, if the price moves the value of 0.45 ATRs from the close, like right now, it's 440.61. I take 440.61, I add the value of the 0.45 ATR, that's 248. So 440.61 plus 248, whatever that is, that will be my first profit target on Monday. Then I'll take my first profit on target on Monday, add it again, that's my second, take my second, add it again, that's my third. And I'll just get out of 10% of however many shares I have remaining at that time. So if we look at the trade, under 30, over 30, under 300, over 300 with the V2, position size properly, taking 1%, dividing by the value of the 2 ATR, placing my emergency stop exactly the value of the 2 ATR from my entry. My end of day stop closed below the 300-day moving average. Next day it moved up, but it did not move up enough for me to take a profit target. Next day it moved up again. It did move up at least 1.45 ATRs from my entry. Took some profits here. Next day moved up substantially. Took 2 profits off. So you see how I'm continuing to take profits, which reduces my position size. I can lock that in. The market can't take that away from me, and it helps to continue to reduce risk. And again, we got to trailing stop level. So took the entry, next day moved up, but not enough to take a profit target. Took profit targets here, took 2 profit targets here, took another profit target here, got to trailing stop level on this day, and then on Thursday was our first close below a previous bar's low. After reaching trailing stop level, I took half of my position, the remaining position, off. So Thursday night, I take the closing price, I add 3 profit targets based upon the 0.45 ATRs. And Friday, of course, we had another huge move up here. I took 2 more profit targets off the table. So I'm continuing to reduce my position size. We're at a 62.04 RSI. Now, if I get to a 65 RSI, now, if I have a close below the 5 EMA, I'm out of the entire position. If it keeps moving up and I get to a 70 RSI and it rejects it, then I'll take half of whatever I have off. And then if that happens, then if I get another close below previous bar's low, then I am completely out of the trade. And I know this probably sounds complicated. I do have a lot of rules, but the reason I have a lot of rules is because I've been trading for 28 years, and there are reasons for these rules. And by the way, if you would like to learn how to trade like I do offer private one-on-one lessons in the evening time via Skype. I offer a 15-hour course. Each session is 3 hours. 5 sessions, that's where you get the 15 hours, and I will teach you step by step all of the trading approaches that I use. I've taught students from all over the world, from absolute beginners all the way up to hedge fund managers. I think they've all been very happy that they've taken the course. So if you really would like to learn the skill of trading and learn it with someone that's been doing it for a long time, just send me an email. Email is in the link of this YouTube video and we can talk about it. It does cost $1,750, but I promise you it's the best $1,750 you'll ever spend. And so if that's of interest to you, just send me an email. Okay. So anyway, here we are now. Like I said, 65 RSI, now the 5 EMA will come into play. You see this red and this blue here. I'm going to talk a little bit more about this later in the podcast when we look at the market in general. But these are some serious resistance levels up here that I'll talk about when we just talk about how the markets are doing and kind of what I see from them as well. All right. So anyway, on Thursday, I sold half of the remaining position with a close below previous bar's low after reaching trailing stop for a gain of 4.38%. And the remaining shares that I have on this particular trade, which has been a really nice one, up 5.85%. So really nice, great trade there with a good risk to reward ratio, confluence of signals. Okay. Caterpillar. Caterpillar is another deep dip buy approach that I took all the way back here on the 1st of November. Why did I take it? Well, another confluence of signals. We had an under 30, over 30. We had a close under the 300, close over the 300. So again, you'll always put the odds in your favor on a trade if you look for a confluence of signals. So this was a nice confluence, under 30, over 30, under the 300, over the 300. I bought here at 231.60. I position size, like I just mentioned in the last example. I placed my emergency stop 2 ATRs below, so I know exactly my worst case scenario risk. And then my end of day stop is simply a close below the 300. You see how close we are to the 300 here? So the next day, even if it would have closed below a penny, I simply just would have been out, right? So I placed my emergency stop 1.5 ATRs above here. Next day moved up nicely, took a profit target off. Next day moved up again, took profit off, got to trailing stop level, which means now in the future, if I get a close below a previous bar's low, I will get out of half. That happened here on the 7th, close below the previous bar's low, locked in a gain of 1.31%. Next day moved sideways, didn't do much. Next day moved sideways, didn't do much. Friday moved up nicely, took another profit target. So the remaining shares that I have on Caterpillar currently up 3.27%, so not too bad. USO, which is oil, I did buy this on the 8th of November. What was the signal? The signal was, see the black line here? This is the 200-day moving average. We bounced right there. So what is the significance of that? It just meant that as soon as the price got to the 200, buyers stepped in, and it gives me a very good risk to reward ratio. So I position size with the bounce of the 200. I placed my emergency stop 2 ATRs below. My end of day stop would be where? Well, why did I take the trade? I took the trade because it rejected the 200. So therefore, in the future, if it closed below the 200, I simply would have gotten out, hopefully with a small loss. Placed my emergency stop 1.5, not my emergency stop, but my trailing stop level 1.5 ATRs above. This is the orange line. And so we're not there yet. We're not in trailing stop mode, but we're still in the trade because we're still closed above the 200-day moving average. And so far, this trade doing nicely, up 2.38%. So, and then Merck. Merck was really a bummer, especially on Friday because the market was up so high. I did get long Merck here on the 3rd of October with what is called a return to value V2. Value zone is this green line, anywhere in between here. We were above the value zone, we moved sideways, we came down into the value zone, we moved sideways, and here we have a V2, bar 1, bar 2, bar 3. Bar 2 goes below bar 1's low, closes above bar 1's close. Got long here, 103.13. My emergency stop on a V2 is a close below halfway of the washout bar. This is this pink line here. Next day, moved up, took a profit target. Next day, didn't do much. Next day, moved up again, took some more profit targets off. Now, this ended up being a losing trade, but what's important here is that I'm showing you that taking these partial profits when you have them, that's why I'm such a big fan of this. Eventually, if your trade does turn into a losing trade, it's a much lower losing trade than if you would have not taken the profits off at all. So again, took the V2 here, took 10% off. The next day, nothing. Next day, moved it up again, took another 10% off. So I locked that in, reduced my position size. Next day, we came down Thursday. We went below the end of day stop at the end of the day and then just closed above it. That kept me in the trade. Friday, we opened higher, went higher, and I took one more profit target off, thankfully, right? So now I took 30% of around 30% of the position off. And then on Friday, pharmaceuticals were just very weak on Friday, unfortunately, even though the market was strong. And clearly here we closed below halfway of the washout bar, so it took a loss of 1.71%. Here's my emergency stop down here. Remember, if the way that I position size, even if I would have got all the way down here, I still would have only lost 1%. So all in all, this doesn't look so great, but percentage-wise, this is a very small loss. And in terms of the stock price, it was down 1.71%. But in terms of total capital, it was probably 0.4%. So losing trade there. So just recap on the daily trades. Remaining shares on SPY up 5.85%. Remaining shares on Caterpillar up 3.27%. Remaining shares on USO up 2.38%. And then on Merck, that was the one losing trade of a loss of 1.71%. All right, let's switch over to the weekly trades. All right, gold on the weekly. Weeklies close on Friday, so that I take weekly trades on Friday. on that Friday, back on 10/6, gold, GLD, went under the 200 during the week and closed over the 200. Gave me a very good risk to reward ratio. So I position size. I placed my emergency stop 2 ATRs below. My end of day stop is simply what? Why did I take the trade? It rejected the 200 during the week. Therefore, the next week, if it closed under the 200, I'd simply be out. Place my emergency stop 1.5 ATRs above. Next week was a monster week. Hit, I can't remember, 2 or 3 profit targets on this week. So lock that in. Market can't take it away from me. Reduce my position size. All sorts of good things happen when you take partial profits off, both offensively and defensively. Next week moved up again, just beautifully. Hit another two, I think it was 2 profits. I think it hit 2 profit targets here, 2 profit targets here. So I took a majority, or not quite a majority, but a large portion off in these 2 big up bars. Next week moved up again for 1 profit target. Keep reducing my position size. My end of day, or my trailing stop level here, happened the very first week that I bought it. So I'm in trailing stop level, which means that if I get a close below a previous bar's low, I get out of half. That happened on Friday. This clearly closed below this low after reaching trailing stop level and locked in and sold half of my position here for a gain, nice gain, of 5.71%. XLF. All right, XLF. I've been in this trade, it seems like 9 years. Not quite 9 years, but pretty long, which is good because if I'm in a trade for any length of time, that means that it is a potential trade. Look, I have losing trades all the time, but if I have a losing trade, I am out quickly. You will never see me be in a trade for 6 months and it's a losing trade. Never, I promise you. But on weekly bars, on monthly bars, if I'm in that for any length of time, it means that I'm in the money. And that is proper, correct trading. Getting out quickly when you're wrong, staying in when you're profitable. That's it. But having rules, right? Having a rules and process so you just don't have to make impulsive decisions. So I bought XLF all the way back here on the 24th of March. So I've been in this trade since March. What does that mean? It means that it's a positive trade. So got long here at $30.71. Why? because it rejected the 250-week moving average. It also rejected the negative third ATR channel. Remember, I like to look for confluences of signal. The main signal was the intra-week rejection of the 250, but because it went under the negative third channel and over the negative third channel, that adds bonus points to the trade. And by the way, 92% of prices stop going down when they get to this negative third ATR channel. So it's just a good thing to know. There are 8% of the time where it continues down. You have to remember that, right? So intra-week rejection of the 250-day moving average, intra-week rejection of the negative third ATR channel. I got long here 3071. I position size correctly. I placed my emergency stop how far below? 2 ATRs below. My end of week stop is going to be simply be a close below the 250. Okay, so I enter, proper position size, place my 1.5 trailing stop level above here, and then of course if it moves the value of 0.45 ATRs from the previous bar's close, I get out of partial, right? Next week, moved up, took some partial profits. Next week, didn't do anything. Next week, moved up again strongly, took more partial profits, and now I'm in trailing stop mode. Next week, moved up again, more profits, trailing stop level, looking for a close below previous bar's low. That didn't happen until here. June 23rd, we had our first close below a previous bar's low. I took half the position off for a gain of 6.4%, kept the remaining because I'm still above the 250. Then we had a month up, took profits, took more profits here, took 2 profit targets here. So as it's moving up, I'm continuing to take more and more profits off. Then we moved down for a few weeks. We have 1 week up here where I took more profits on this bounce. And then we came all the way back down. Now last Saturday, or not yesterday, but the Friday before that, had this closed below the 250, I simply would have been out of the trade. This would have been a legitimate new entry on this trade because it went below the 250 and above the 250, just like when I bought it over here. But I didn't add, but I kept me in the trade. And then this last week, just a monster, or 2 weeks ago, just a monster move up again where I took more profit targets off. Last week was up a little bit, but no profits. So again, I've been in this trade for a long time. The remaining shares that I have on this trade up 9.41%. Pretty good. All right. Then I did have a couple losing trades on the weekly last week. But again, when they're losing trades, I'm out quick. I was out in 1 bar. Oh, let's get over here. Back to this. Over here. So yeah, this was a legitimate signal on Pfizer last week. We went under the 30 RSI, over the 30 RSI, plus we had a V1. I got long here 30.90 position size, emergency stop down here, trailing stop level here. But this one just didn't work. Last week, it just boom. Look, it's 29.04. It closed below the 30 RSI. I'm simply out. Now, I could have just said, I don't think it's going to go any lower, but then I'd be breaking the rules. Look, if it goes back over 30, I can get back in. Right? And actually Pfizer is on the list of what I'm looking for a potential new trade. But it went under 30, over 30 last week. Unfortunately, it just closed below 30. I'm out of the trade for on the stock price of minus 5.16%. But again, in reality, how much did I really lose? Well, even if it would have gotten down here to my emergency stop, I would have lost 1%. This is probably about a 0.4% loss total capital, which is okay, right? You can deal with that. You can make that back. So on Pfizer here, loss of 5.16% with the close under the 30 RSI. And then last but not least, FXY. I bought FXY back here on the 27th of October, under 30, over 30, plus a V1. Position size, emergency stop, 2 ATRs below, 1.5 trailing level, 1.5 ATRs above. Last week, it went below the 30 again, but closed above 30, kept me in the trade. And then this week, it just kind of gave up the ghost, closed down 26.86, so it closed below my stop. But very small loss of 0.99%. So just quick overview again on the weekly trades. Remaining shares on gold up 5.71, XLF remaining shares up 9.41. Pfizer, loss of 5.16, and FXY, loss of 0.99. So not too bad. All in all, nice, good, profitable week. And yeah, it'd be nice not to have the losers, but you're always going to have them, everyone. You just got to get used to them. The key is when you have that loss, you just have to be quick. You have to be quick to get out of it. Be patient with those winners. Be very impatient with the losers. That's what trading is all about, everyone. All right, let's get over to trading psychology. This is from Peter Robbins. You can follow him on Twitter X, PR Robbins. Peter Robbins was featured in Unknown Market Wizards. Really great series of books and great trader. Not a lot of people know about him. Well, they didn't know about him. They know about him now. But whatever Peter writes, I would suggest you listen to because he is a market wizard. He says, it often pays to increase your risk when sitting on more house money. But don't forget, house money is still your money. Very important. It often pays to increase risk when you're sitting on more house money, but don't forget, house money is still your money. Increase risk if market conditions warrant it. But beware of confusing market conditions with overconfidence. Boy, there's a lot to unpack there. Um, you know, when we get into winning streaks like we have recently, it's easy to become kind of feel like you're bulletproof. Like, oh, it's just going to continue up and it's going to continue up. I can just add more and more risk. But you have to balance that fact with it. We are coming into some significant resistance levels in the S&P and the Qs, and I will go over that with you a little later in the podcast to show you. But there's a sweet spot in between certain levels where, yes, if you are doing well, you can increase. But actually, the way that I trade, I talked earlier about taking 1% of your capital as your maximum allowed risk. Well, as your capital increases, that 1% is a larger number. So using that formula that I use, it does automatically just increase your risk as you are doing better. And if you're in a drawdown and your account's going down, 1% of a lower number is a lower number. So just that by itself, using that 1% risk kind of does this automatically. But yes, I mean, even, professional gamblers, when they're doing well, they bet more. When they're doing poorly, they bet less. And it's really the same in the market. If you're doing better and you're increasing, yeah, I'm okay with increasing your risk, but there is a fine line between feeling bulletproof or feeling overconfident to that the market's in a good situation. So just remember that. But I think the main takeaway that I want you to get from what I'm saying here is that when you're doing well, you very often can feel like you're bulletproof and that you're never going to lose another penny again. And you will. And on the flip side, there are times where you never feel like you're going to make another penny, and you will. So keep that in mind. And of course, you have to look at the levels. We are coming in some significant levels here with what's going on, with the prices in the market. We're getting near some fair value gaps. We're getting near to some order blocks and things like that. And I will discuss this a little bit later. But be careful. But I think the big takeaway here is that if you use the money management that I use, 1% of your capital, when you're doing better, you are going to be adding more risk. When you're doing poorly, you are going to be adding less risk. So please hope that's helpful, everyone. Please follow Peter Robbins at PR Robbins over on Twitter. He has great information. All right. Let's get back to the charts and let's take a look at what I'm looking at for next week. All right, so first we're going to start out on the dailies here. Like I mentioned, the market has rallied so much from last week that some of the big key names, Apple, all these kind of things, they're really at levels where I just don't feel comfortable buying them. I think they will. I mean, they may continue up, there's no doubt, but they're just at levels statistically where a pullback is more likely than a continued move up. So that's why I only have 4 potential stocks to look at on the daily charts here, but they're reasonable levels and they have good technicals. So that's why I'm highlighting this. And by the way, before we get to those, just want to mention If you are enjoying this podcast, if you're finding some value from it, I really would appreciate if you could just hit the thumbs up button real quick. Really helps out the channel, lets YouTube know that there's some valuable content here. So if you wouldn't mind and you find it valuable, just hit the thumbs up button. We'll all be good. All right. Let's start out here, Johnson and Johnson. All right. So Johnson and Johnson not doing so great, as you can see, compared to the rest of the market, but it is starting to look quite interesting to me. Johnson & Johnson's a good company. You see the low we made here on the 27th. You see how deep these MACD bars are? This is what is called MACD is a measure of momentum. And the deeper these bars move down, the more selling momentum there is. And I learned this approach. It's called double bottoms bullish divergences. I learned this approach studying with Dr. Alexander Elder, very famous trader, very, very famous author. And he believes, in his opinion, that double bottoms, bullish divergences are some of the most powerful technical indicators that there are. And I really would have to agree. It's just that they don't happen very often, but one is happening on Johnson & Johnson. So a double bottom bullish divergence is when we have a low, you see how deep the red MACD bars are, showing a lot of selling momentum. Well, after you have the first low, you have a rally, and then you need to rally into some green bars. Well, currently we have some green bars here. But the key is if we come back, and we're very close now, if we come back and test this low, then you have to take a measure of how deep the red MACD bars are, if there are MACD bars at all. Well, look, I can already tell just from experience that if we do get down to test this low, there may not be any green bars or any red bars, or if we do have red bars, they're going to be not as deep here as they are here. That is called a double bottom, the bullish divergence. And why it's helpful for us as traders is it shows that this move was very strong to the downside. And this second move, although it looks strong, is from a MACD perspective, is not as strong as the first one. And it means it's running out of momentum to the downside. And in other words, if it's running out of momentum to the downside, it really means you're running out of sellers. And the implication, if you're running out of sellers, is that you're going to move up. So if you have a double bottom and a bullish divergence, very likely it's about time it's going to move up. Now, just because you have a double bottom bullish divergence doesn't mean you just enter, right? I've seen double bottoms, bullish divergences that happen for a long time. You still need a valid entry signal to get in. So what I am waiting for next week is if we test this previous bottom over here. I know we're going to have a double bottom bullish divergence. That's step one. But I still need an entry signal, like an under 30, over 30, ideally an under 30, over 30, rejection of the negative third ATR channel. So what I'm looking for next week on Johnson & Johnson is it to continue down, go under 30, over 30 during the day, or it could close under 30, close back over the 30. That would be a valid signal, especially big picture. It's an under 30, over 30, which is valid, but it's way more valid an under 30, over 30 if it comes when you have a double bottom bullish divergence. Okay, so that is what I'm looking for on Johnson & Johnson next week, ideally an under 30, over 30, and a rejection of the negative third ATR channel would make that even better trade. But if it just simply has an an intraday rejection of the 30 RSI, I would take the trade, especially in light that we have a double bottom bullish divergence or an under 30 over 30. So just make simple, some kind of rejection next week of the 30 RSI level on Johnson & Johnson. It would get me interested in potentially taking this trade. Southwest Airlines. My gosh. This stock at one point was a $64 stock. Now it's $23.16. Can you imagine that? I don't think Southwest is going out of business. You never know. But it is starting to show some potential. Excuse me, still fighting the cold I had last week. But what I'm looking for next week, Monday only, by the way, Monday only on Southwest Airlines LUV, is I'm looking for a higher low V1. And we're starting to format right now. Here's the value zone, green line, anywhere in here is the value zone. A higher low first has to close below the -1 ATR channel, the bottom green line, which it did. Then it has to move into the value zone, which it did. It then has to pull back, ideally test the -1 ATR channel like it did. Ideally, MACD has to be positive, which it is. So Monday only, if we can close above 2335, that would give us a higher low V2. A V2 consists of 3 bars. Bar 1, bar 2 goes below bar 1's low, which it did. Bar 3, that's why I'm saying Monday only, has to close above bar 1's close at 2335. Then we would have a V2. This low is higher than this low. So Monday only, if we close above 2335, that would be my entry, higher low V2. I would position size, place my emergency stop 2 ATRs below. And what is your stop on a higher low V2? Halfway of the washout bar. This is the washout bar. Green line would be halfway. But again, I'm only taking the trade if we close above bar 1's close, 2335. Pfizer. All right. So Pfizer, I had that losing trade last week on Pfizer. But if we look at Pfizer a little bit more carefully here, this is a double bottom bullish divergence. And it's even better than a double bottom bullish divergence. Look at the low, deep red MACD bars. We've rallied into green. Friday, we went lower than this low. But you see how there's no red whatsoever? This is better than a double bottom bullish divergence. This is called a double bottom bullish divergence with a missing right shoulder. In other words, even though we're at the level, or we were at the level, there's no red bars. This is even stronger. So because of this, what I'm looking for next week, and this already is a double bottom bullish divergence, again, is an under 30, over 30. That's all I need to get into this trade, especially because we have this double bottom bullish divergence and missing right shoulder. And then last but not least, Tesla. All right, so Tesla has been fairly weak compared to the rest of the stocks. This was a legitimate entry signal on Friday, intraday rejection of the 250. But I don't like where it's at right now. It's above the 250. We have the 200 above it. It's kind of in a purgatory situation. So what I'm waiting for on Tesla is a double bottom bullish divergence under 30, over 30. Here's the low. Very deep red MACD bars. We rallied, yes. But I would have to come all the way back to test this low so that we have a double bottom bullish divergence. But really what I'm looking for, under 30, over 30. So you can kind of see there's a common theme here with almost everything I've talked about. Johnson & Johnson, Pfizer, Johnson & Johnson, Southwest, Pfizer, Tesla, all creating double bottoms, bullish divergences. I still need the trigger. So real quick recap on Johnson & Johnson. Looking for an under 30, over 30. That's really the only thing that will get me in this trade at this point. On the daily is an under 30, over 30 with a double bottom bullish divergence. Southwest Airlines, again, looking Monday only. This is the only thing on Monday if it creates a V2. I guess I should mention, because of the double bottom bullish divergence that it looks like it's going to form, an under 30, over 30 would also get me in the trade. Okay, but first, foremost, higher low V2 having to close above 2335 as option number one. Option number two, less likely, would be an under 30, over 30. Pfizer, under 30, over 30 with a double bottom bullish divergence. And Tesla, looking for an under 30, over 30. That's about the only way that I'm going to get into that trade. Oh, and I should say that theoretically, all of the four that I'm looking at next week, all four of them could trigger at the same time. Does that mean that I would buy all four of them? No, it doesn't. I only will buy one trade, the best trade of the day. So if all four of these triggered, I would have to pick the best one. What makes it the best one? Well, how many confluences and combinations of indicators are lining up at the time? If we have an under 30, over 30, but another one has an under 30, over 30 and a V1, well, obviously that one would be better. I also look at relative strength of how that particular market is performing to the broader market. I look at the higher time frames. What's it looking like on the weekly? Maybe one has an under 30 over, maybe both of them have an under 30 over 30 and an under and a V1. Well, then I have to look to the higher time frame, the weekly, to see if maybe on one it rejected a level on the weekly that the other one didn't reject on the weekly. So again, this is what I teach in my one-on-one course, really how to narrow down your candidates, because I could have 5 great candidates in one day, but I need to narrow it down to the very best one. Multiple confluences, relative strength, higher time frames. Again, this is what I teach in my course. All right. So, all right, let's get on to the weeklies now. All right, so I don't talk about shorting a lot, but I definitely do have approaches that I use for shorting, and I am starting to see quite a lot of them on the weekly charts. So I'm going to go over this with you. So this is Apple on the weekly charts. So you've heard me talk about fair value gaps and so forth. Basically, a fair value gap is when we have a level of liquidity like we do here, and then we run it, meaning that we go above it, and then we have a big break to the downside that takes out the first swing low, which that happens. Well, now we have a fair value gap on the big crackdown. The low of this bar and then the high of this bar. See, anywhere in this level here, this is essentially a shorting level. And we are in here right now. But what I am waiting for is the bottom of this order block right here. 191.50. So what is that? That's 5 points above. So this is what I learned from studying ICT. Look up ICT on YouTube. Very, very interesting stuff. But what I'm looking for on Apple is I will short Apple if and only if we reach 191.50. That will be my shorting level. My end of day stop will be a close above a high, so it would have to make a new high on the year. And then, of course, I'd have my emergency stop up here. Now, this is quite a large way. So instead of using a 2 ATR emergency stop, I would probably use a 3 ATR emergency stop to give me more room, and it would just affect your position size to the downside. So again, just in general, or just to be specific, if Apple reaches the bottom of the order block, here's the order block here, 191.50, I will potentially short Apple with the stop being a close above that, above the all-time high there of about 197.64. Berkshire Hathaway, same thing. Here's our level of liquidity. We ran the level of liquidity. We broke strongly to the downside. Anywhere in between 362 and 365, this will be my shorting opportunity in that area here. But just to make it simple and more precise, if it gets to 365, the top of the fair value gap and the bottom of the order block, will be my short position only at 365. That will be my shorting area, 365. I'll position size. If it takes and makes a new high, that will be my end of week stop, and then I'll have my emergency stop up here. Alphabet, same thing. Here we have our level of liquidity. We ran the level. We broke structure to the downside. The top of that gap is right here, 135. To just make it easy. If it reaches 135, that will be my potential shorting location. My end of week stop will be close above the high here, and then I'll have my emergency stop up here. MasterCard, same thing, level of liquidity. We ran it. We broke market structure to the upside. The gap is here, 407 to 402. Just to make it easy, 407 would be my potential shorting location. My stop would be a close above the high, emergency stop above. Morgan Stanley, this is a long. We had a close under the 200 and over the 200. I mentioned this. If we pull back to the downside and reject that 200-day moving average on the weekly, that will be my potential long. Remember, Apple, Berkshire, Google, MasterCard, all potential shorts. But this one along, if we check back here, give me a good risk to reward ratio with a rejection of the 200-week moving average. Pfizer, talked about Pfizer on the weekly, but I'm also going to, or on the daily, I'm also going to talk about it on the weekly. We're at 29.04. If we get another close back above the 30 RSI, I would potentially take another long try at Pfizer. And then last but not least, we have VIX. VIX's volatility here. We have a double bottom with a bullish divergence. We're at a 32.87 RSI. I'm looking for next week an under 30, over 30 would get me long VIX or long volatility. So real quick recap, just to make it simple, Apple potentially short at 191.50. That's the only location that I'm going to short it at. 191.50 stop, close above this high here. Berkshire potential short 365. Google potential short 135. MasterCard potential short 407. Morgan Stanley looking for a long, looking for a test going down and test of the 200 to get long. Pfizer looking for an over 30 RSI, and VIX looking for a rejection of the 30 RSI to the downside. And again, just like on the dailies, these all could trigger on the same day, but I would narrow it down to the best one. Confluences, combination of indicators, relative strength of that particular market compared to the rest of the market, and then of course looking to the higher time frame to narrow it down to the very best one. So okay, so I talked earlier that I wanted to kind of go over some of the major levels of just the markets in general, but before I do, just want to remind you again, if you would like to learn from someone who's traded for a long time, who has taught many people, has lots of experience, I'm your guy. I love to teach. I've taught so many people around this world. I teach them step by step all the different approaches that I use, and I've had so much good feedback, so many good reviews. So if you are interested in learning the skill of trading, just send me a message. The message or my email is in the link of this description, and we can get the conversation started. But I know you're going to be happy that you took the course, and I know you're going to become a better trader. And also, if you like online courses, I have a great online course. I've sold so many of these around the world. It's called the Deep Dip Buy Stock Trading Approach. It's on udemy.com. The link's in the description. I've had so many good reviews on this particular online video course, and it's very affordable. It's between $12 and $15. And if you're not in the financial situation to take the one-on-one, then this is a great alternative between $12 and $15 depending on the day. For Udemy, but I teach you step by step how to trade the deep dip buy approach. There's 9.5 hours of video. There's 26 videos total. There are 15 study guides, and it's a really good alternative to taking the one-on-one because it's much less expensive. So consider that. The link's in the description. All right. So let's look at the SPY, for example. So I was on the weeklies on Apple and Google, I was just talking about order blocks and fair value gaps. Well, this bar here, back on the 14th of September, this is an order block. which basically means this was the high of the bar before the structure change took place. Anywhere in between the high and the low of the order block, so in other words, between 451 and 447, anywhere in between, that's why I've made it red here. It's a very, very good place to potentially short. And your stop is very close, just to close over that order block. So if we move up into the 447 range, I would consider shorting SPY here. Anywhere between 447.70 and 451 is a really good place to short. It doesn't mean it's going to work, but from order blocks are very, very strong. So in this red bar here between 447.70 and 451, I would consider a short. In addition to that, between 444.90 and 447.70, there's a fair value gap. So I'll just have to see how things go, but anywhere basically between 444.90 and 451, multiple short locations here to potentially short at. So I'm not suggesting that you take this trade, but what I'm suggesting to you is that if we do continue to move up in the SPY, more than likely we're getting into a very major level of resistance for the market in general. So just keep that in mind, okay? Also want to take a look at the Qs. This one's on the monthly bars. And I talked on Apple and Berkshire and Alphabet as far as those order blocks. Well, it shows up here on the monthly bars as well. We ran liquidity. We had a big break to the downside. We changed market structure. Look, we came right back in. See, when we came right into this gap here, then we failed. Well, we're right back in it. We are right back in it. And so I would potentially get short Qs on the monthly at 384. So we're not that far away from them. It's about 6 points away. We may just go and make new highs. We really might just make new highs. But I'm just saying these order blocks are very, very strong. And here we are. We're right there. So I may potentially take a short on the Qs here at 384 with my stop being at the close here. Let's look at some other things. Bonds. You know, I was very bullish on bonds down here, and it really did work out. The more bonds go up, the more likely that the stock market will go up, because as bond prices move up, interest rates move down, and lower interest rates are more bullish for the market. This looks like we've had a bit of a top here on bonds. And, you know, Friday after the close, Moody's came out and they're downgrading the U.S. debt. I don't think that's going to be great for the market on Monday. And I know it's not going to be good for TLT. So I was just talking about these levels above us on the SPY and the Qs and so forth. And so if bond prices do come down and interest rates go up, more than likely we'll be closer to a top in the stock market. So keep that in mind. There's a lot of levels. There's these other markets like bonds and the dollar and so forth that are showing us that we may be near a short-term top. So really the reason I'm telling you this, be careful. We talked about feeling bulletproof and you know, possibly increasing as things are going well. Well, they are going well, but keep in mind the SPYs and Qs are coming into some major resistance levels. We have bonds that look like they're probably going to go down from here. So just be careful. There's a time to do it and a time not to, but I think we're a little long in the tooth with where the markets are right now. So anyway, I hope this was helpful, everyone. Please be careful next week trading. I always like to leave off with, please go out and try to do something nice for someone today. You know, one nice act of kindness really would make the world a better place if we were to all do that. If I could also ask the second favor, if you could try to go out and do something nice for an animal today. They appreciate acts of kindness. I was raised with many animals, and I know they appreciate acts of kindness just like we do. So if you could try to do one nice thing for another human being today, one nice thing for an animal today, it really would make the world a better place. And I think the world has room for improvement, don't you think? So I appreciate you being here. And God willing, I will see you next weekend. But thanks so much. Enjoy the rest of your weekend. And again, please be careful next week. Don't get caught up into the FOMO of chasing things. Be patient. Wait for your entry. Wait for the entry to come to you, giving you a good risk to reward ratio, and get out quickly if you're wrong. Be patient with it if you're right. All right. Thanks a lot, everyone. Take care, and I will run the U.S. legal disclaimer on the way out here. Bye, everyone.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. Rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.